Welcome to Darasa Online. My name is Kevin Nkwera. I'm an accountants teacher. Today we are starting to revise a topic called the nature and the context of accounting. I'm expecting that at the end of this lesson, you'll be able to explain the origin of accountants. You'll be able to identify and describe the branches of accounting. You'll also be able to explain the role, purpose of accounting. You'll also be able to identify and explain the qualities of accounting information. You'll be able to identify the users of accounting information and their information needs. And the last, you'll be able to explain the meaning of accounting principles. Now let's see the history of accounting. Now this history resembles with the commerce evolution. In commerce, there are various stages in commerce. The first stage in commerce evolution, there were no trade at all. People were just producing items or goods for their own consumption. Then we came to barter trade system, and then to manners of evolution. At a time when we started, commerce started money, it's a time when also accounting started. So accounting started in early societies when exchange of goods and services using accepted medium of exchange called money started. The exchange of this nature in accounting language is known as transaction. The volume of transaction as it is today, raising the need of recording them systematically, partly for ascertaining the direction of a business and intervals, and partly to know what the business owes to other people and those who owes the business. The systematic record of what happened on today or hour to hour for enabling a businessman to extract and present a complete and informative income statement or to ascertain his financial position is known as accounting, or its rudimental stage as bookkeeping. Early reference to the subject of accounting may be found in the work of certain Greek people Oriental writers. However, the systematic approach to double entry system of bookkeeping and accounting as we know it today has dated back to the late 13th century in 1494. Luca Pacioli, a Franciscan monk living in Italy, published his well-known work, Summa de Arithmetico Geometrico Proportionate et Proportionalite. It was primarily a study of mathematics, but it also included a section in bookkeeping procedures. Since then, accountants has grown to become a world-renowned activity important to the functioning of the world economy. And that is a history of accounting. Now let's define what is accounting, and then we'll see the branches of accounting. Now, what is accounting? Accounting is defined as an art of recording, classifying, and summarizing in a significant manner and in terms of money transaction and events which are of financial character and interpreting the results thereof. Now, the following are branches of accounting. 1, financial accounting. It is the original form of accounting. This field is primarily concerned with the provision of financial information about the business firm, mainly to the external users. It is mainly confined to the preparation of financial statement for the use of outsiders. Financial statement, it's in terms of income statement and a statement of financial position. Like shareholders, debentures holders, bankers, creditors, and the government. Then we have another branch of accounting. This is a managerial accounting. It is accounting for management. That is to say, accounting which provide necessary information to the management for discharging its function. For example, planning and the control of the operations of the undertaking. Management accounting also includes cost accounting, budget control, statistical, and internal auditing. Then we have cost accounting. Cost accounting involves application of costing technique and the principles to cost control and the ascertainment of profitability. Cost accounting includes labor costing, manufacturing, cost volume profit and analysis, that is CVP, etc. Another branch is government accounting. Government accounting is a branch of accounting which is a financial counterpart for the government sector. Of course, this one is the same with the financial accounting in business organization. But in government, we have government accounting, and in business, we have financial accounting. But the purpose is the same. Then we have social accounting. Social accounting is concerned with the statistical classification of the economic activities so that we are able to understand easily and clearly the operation of the economy as a whole. It involves recording, classifying of economic activities like fisheries, etc. in the economy and the applications of the information to various economic decision making. Now let's move now to the role, purpose of accounting. The purpose of accounting is to provide financial information, of course in terms of statement of financial position and the income statement, to the stakeholders of the business, management, investors, and the creditors. Accounting measures and summarize the activities of the company and communicate the results to management and the other interested parties. Now let's now explain or discuss the qualities of accounting information. Now, a good accounting information must have the following qualities. The first, relevance. It is important that the accountant select from all data available which are mostly likely to meet the needs of the general body of users of accounting information. Of course, we have various accounting information or data. So as an accountant, you are supposed now to select data which will be acceptable and in decision making, especially to this accounting users of information. Then we have verifiability or objective. Accounting information should be measured in such a manner that two or more accountants of equal competence should be able to measure the same data and arrive at approximately similar results. Now here a good example or a relation between the accountant and the auditor. Accountant is there to prepare financial statement while the auditor is investigating. So the result which accountant is getting and the result which auditor gets, it's supposed to be similar. That is verifiability or objectivity. Then we have understandability. Accounting information to be useful must be understood by the different users. It has to be presented concisely and with clarity. So we have supposed to present well so that a user of accounting information can read and understand. Then timelines. Accounting information should be available to the user at the appropriate time so that it is incorporated in the decision-making process. Of course, we are supposed to get feedback immediately. Assume that the financial year is ending 31st March. So we are expecting at maximum after 2 weeks we will get accounting information. Now assume that the accounting information will reach to users after 2 months. Now that one, it's not a good quality of accounting information because managers etc. will fail in decision making. It will be too late. Then we have comparability. Accounting information should facilitate comparison of the entity's operation results over time and between different entities. To attain comparability, preparation of accounting information should be consistent from one period to another within a business entity. Okay, let's see now an example of this. Our company financial year is starting 1st July and ending 30th June. And one of the policies is to have assessment of our performance every after 5 years. Now, assume that this is the assess of the performance for 5 years. Assume that now the company will carry this assessment next year on 30th June. Now, in order to be fair or to have a good comparison, we are supposed to stick with the one accounting method. And we have various accounting methods. For example, in the depreciation, we have different methods like a straight line method, sum of the year's digit, and a reducing balance method and the other method. Now, in order to be fair, in those 5 years, we are supposed to use the straight line method. That one will be a good comparison, not to mix this method. But also there are other methods, of course, for valuation of goods. We can use LIFO or FIFO. Also, we are supposed to stick with the one method. But remember that a change of method can be allowed if there is a sound reason. And the effect of change of method on the profit reported and the financial position must be quantified and disclosed. Now, in the industry comparison, assume that we want to compare our company and another company. And our company is in nature is a telecommunication company. Telecommunication company. Now, in order to have a good comparison, we are supposed also to measure this comparison with the same organization which are having the same nature. For example, Airtel and Voda or Tigo and Voda. So let's move now to users of accounting information and their information needs. The following are users of accounting information and information needs, starting with the proprietors. A business is done with the objective of making profit. Its profitability and the financial soundness are therefore matters of prime importance to the proprietors who have invested their monies in the business. Of course, the owners are interested to see whether the company is getting profit or not. So is interested in the financial statement to see whether his company is getting profit or what. Then managers. Accounting disclosures greatly help managers in knowing about what has happened and what should be done to improve the profitability and the financial position of the enterprise in the period to come. Of course, the managers are there on behalf of owners. So their interest, of course, will be the same, to see whether there is a profit or not. Now, after having that information, whether maybe there is a profit or whatever, we are supposed now, or the company maybe will want now to expand the company or the business, but also maybe they can decide to advertise so that their company can be known to the people. Then other users of accounting information are creditors. Creditors are the person who have extended credit to the company. They are also interested in the financial statement because this will help them in ascertaining whether the enterprise will be in a position to meet its commitment towards them, both regarding the payment of interest and of the principals. Now, of course, these creditors are suppliers of goods or other assets in a company. So they are interested in a financial statement to see whether we are able to pay them. And of course, maybe they will check their current ratio, etc. So that is a creditor's interest. Another users of accounting information are prospective investors. A person who is contemplating an investment in a business will like to know about its profitability and the financial position. A study of the financial statement will help in this respect. Of course, the investors are the same with the owners, so their interest will be also the same. Investors are people who want to invest something in order to get the profit. So they are interested with the companies which are getting profit so that they can invest there. Another user of accounting information is the government. The government is interested in the financial statement of a business enterprise on account of taxation, labor, and corporate laws. If necessary, the government may ask its officials to examine the accounting records of a business. Of course, we know that one of the sources of revenue of the government is a tax. Now, they are interested with the financial statement so that they can know which company is getting profit or loss, so that they can tax at a right amount. Then we have employees. The employees are interested in the financial statement on account of profit sharing and the bonus schemes. Their interest may further increase in case they purchase shares of the companies in which they are employed. Of course, in other companies like Tanzania Cigarette Company, Tanzania Breweries, of course, the staff are getting bonus. Now, as staff, as employees, are interested to see the financial statement so that they can be assured with the bonus. But also assume that you are employee, but also you are shareholders. You buy shares in that company. So you, at the same time, you are employee, but also you are a shareholder. Of course, you'll be interested with the accounting information. Then we have citizen. An ordinary citizen may be interested in the accounting records of the institutions with which he comes in contact in his daily life. For example, bank, public utilities such as gas, transport, electricity, companies, etc. In a broader sense, he is also interested in the accounts of government companies, public utilities, concerns, etc. as a voter and a taxpayer. Now, as a citizen, of course, maybe I have an account in the National Bank of Commerce. Of course, I will be interested to see their accounting information. In case they are getting lost, of course, I will move my money there. So we are supposed now to, as a citizen, to check the financial statement for those companies which we have contact. But also we are supposed to see accounting information of companies like parastat organization, like UNESCO, etc. Because we are taxpayers, so we are supposed to know what is going in those companies. Then let's now move to the basic accounting principles. Now, many accountants is a semi-science. Is a semi-science because we use the principles in preparing the financial statement. It's not per se science like a chemist, but of course it's a science. But also is an art because we are dealing also with the people. Now, accounting principles are also termed as accounting standards or accounting postulates or accounting convention. May be defined as those rules of accounting that should be followed in the preparation of all accounts and the financial statement. These principles can be classified into two categories. One, accounting concept, and two, accounting convention. Now let's start with the accounting concept. The term concepts includes those basic assumptions or conditions upon which the science of accounting is based. The following are important accounting concepts. 1. Business entity concept. Business entity concept is also termed as a separate entity concept. Accountants treat a business as distinct from the person who owns it and the other entities. Then it becomes possible to separate the transaction of the business from those of proprietors and the other entities. Without such a distinction, the affairs of the firm will be mixed up with the private affairs of the proprietors, and the true picture of the financial affairs of the firm will be compromised. A good example is this. Assume that I'm the owner of a company. Now, I used my money from my pocket to buy vitenge for my wife. The one who bought this vitenge on my behalf is my purchaser or purchasing officer. But money used to buy those vitenge are coming from my pocket. Now that one will not be entered in the books of accounts. However, the purchaser or my purchasing officer or in the company bought this vitenge on behalf. we are only recording transactions which affect the business cash or bank account. Otherwise, we are not going to post. Now, to avoid this, in order to get the true picture of our financial the transaction, we are supposed to separate or to use this concept. And this also will apply to other business companies. Then we have going concern concept. The business is assumed to continue its operation indefinitely unless there is evidence which indicates otherwise. In this context, the business should continue to value all its non-current assets at original cost, as it is not foreseen that they will be sold. That is why we have a non-current asset account, but also we have provision for depreciation, so that we can value our stock, our asset, our non-current asset, according to the cost or historical cost. But also in accounts, we are, especially this asset account, we are writing balance brought down to show that the business is still going on. That is why we are writing balance brought down in our accounts. Then we have another concept, which is a money measurement, also known as a unit of measure concept, and states a position that accounting is more concerned with the activities capable of being measured in monetary terms. Therefore, money is used as a unit of measure in recording and reporting all transactions of the business. Of course, our unit of measuring is money, and that is why in all accounts we have amount column. So money is a measurement. That is why we are saying money is used a unit of measure in recording. And also, according to the definition of business transaction, we are saying that it is a movement of money or money worth. And that is a business transaction. Then we have a cost concept. Transactions are entered in the books of account at the amounts actually involved. Suppose a firm purchases a piece of land for Tanzania shillings 150,000, but consider it as worth Tanzania shillings 300,000. The land will be recorded at Tanzania shillings 150,000 and not Tanzania shilling 300,000. So in accounting, we are not consider about market value. We are just considering the amount involved in that transaction. A good example is this one. The market value of that land is 300,000, but the actual money which we used is 150,000. So we are supposed to use the money and the cost which we used, and not the market value. And this one resembles with the money measurement concept. Then we have dual aspect concept. Dual aspect concept, also known as the duality principle, is a fundamental principle that necessitates the recognition of all aspects of an accounting transaction. Dual aspect concept is the underlying basis for double entry accounting system. Of course, here now, we are supposed now to use double entry, and that is why we are saying it's a fundamental principle. Assume that we bought an asset. We bought an asset, say motor van. We bought a motor van. We bought a motor van, Tanzania shillings 500,000. Now there are two alternatives. Either we used the cash to buy this motor van, or we bought this on credit. So there is a cash or credit. Now, according to the double entry laws, and that is our concept, when the asset is increasing, either through buying or through maybe returns, we are supposed to debit. And when asset is decreasing, we are supposed to credit. So here now, we bought a motor van. Assume we bought this motor van using cash. So we will debit motor van and we will credit cash. That is 1. 2, we can debit motor van and we can credit a creditor who supplied these goods. For example, Toyota Motor Mart. Now, when liability is increasing, we credit. When liability decreasing, we debit. And that is our dual aspect concept. So it is a fundamental principle. Another concept is the accounting period. Although a business is assumed to continue to exist indefinitely, its life can be broken into periods of time, usually 12 months, during which results can be measured. The significance of this concept is that users do not have to wait until cessation of business to determine profit or loss. And this is the financial years. In the government, financial year of the government is starting 1st July and ending 30th June. Other businesses can start 1st January ending 31st December. We are supposed to have segments. We are supposed to have financial years so that we can determine whether we are getting profit or not. It's not good to have a business without stopping. Just doing business without knowing whether you are getting profit or not. So we are not waiting until cessation of the business to determine profit or loss. We are supposed to have segment, and these are years. Then we have accrue concepts. Revenue should be recognized when earned rather than when cash is collected. And the expenses should be recognized when they are incurred, that is to say, when goods and services are consumed, regardless of when cash is paid. And therefore, here now, we have 4 adjusting entries. So the 4 adjusting entries, the 4 adjusting entries, we have 1, prepaid expenses. 2, we have accrued expenses. 3, we have prepaid income. And 4, we have accrued income. Now, these are basic accounting adjusting entries according to accrue concept. Now, prepaid expenses, it means that we paid more than it's supposed to be. For example, rents per year is Tanzania shillings 12,000. This is the rent per year. Is Tanzania shillings 12,000. Assume that we paid rent. We paid rent for that year. We paid rent in that year, we paid rent maybe Tanzania shillings 13,000. But our rent per year is 12,000, but we paid 13,000. So the difference here is 1,000. Now this 1,000 is not an expense of this year, is a prepaid expenses. And that is the accrue concept. But also assume that this rent we paid 11,000. So it means that 1,000 now will be accrued expenses. And that is the accrue concept. The same applies to income. We can receive this 13,000, but actual money is supposed to be received is 12,000. So 1,000 now will be prepaid income and will be liability. The same applies to accrued income. We assume that we have received 11,000 instead of 12,000. So 1,000 will be accrued income, and that is the accrue concept. Now, matching concept. In determining profit or loss at all times, revenue should be matched against the expenses incurred in the process of generating that revenue in the same period. It's necessary to recognize all the revenue or income and during a period regardless of when money is received. In the same way, all expenses incurred by the business should be included regardless of when money is paid for them. It is evident that accrue and the matching principles are closely connected. That is why in matching now, we want now to get exactly amount of expenses in that year. Of course, we will use also these adjusting entries in order to get exactly the amount which is incurred. So that is the adjustment of these adjusting entries so that we can get the correct information. Then let's move now to accounting conversions. The term conversions include those customs or traditions which guide the accountant while preparing the financial statement. The following are the important accounting conversions. Then conservatism. Conversion of conservatism, also known as conversion of prudence. Financial statements are usually drawn based on conservatism, where two or more equal acceptable accounting methods or procedures, the accountant should adapt the method which understates the profitability or value of asset rather than overstating them. Secret reserve are not permitted. It means that in accounting, we don't want to overstate the amount of profit. Now, assume that we have this method of valuing our stock or calculating the depreciation charges. Okay. Of course, we have say a straight line method, as I said earlier, in the depreciation straight line method. We have say sum of digits, but also we have reducing balance method. Now, of course, we want to calculate the depreciation charges. Of course, in the straight line method, the amount of depreciation is fixed every year. But in reducing this sum of digits, the amount of depreciation is reducing every year. Now, as an accountant, you are advising now to take the method which will give you higher expenses so that the profit can be understated. So it's good now to have a method which will understate the profit rather than the method which will overstate. And also about this reserve, secret reserve or special. When secret reserve are existing in the company, of course, the statement of financial position will look better than its actual. So this reserve are not permitted as far as these principles are concerned. Another convention is a full disclosure. According to this convention, accounting reports should disclose full and fair the information they purport to represent. They should be honestly prepared and sufficiently disclose information which is of material interest to proprietors, present and potential creditors and investors. For example, contingent liabilities or market value of investment are shown as footnotes to financial statement. Now, a good example of this one, maybe we have two balance sheet A and a balance sheet B, or statement of financial position A or statement of financial position B. So let's look now the statement of financial position. This is our statement of financial position. Financial position. Now we have A and a B. This is the A and this is the B. Now this is our assets. Now this is a non-current asset. Non-current asset. Now company A is having 500,000 and the B, it's also the same company, but I want to show you the full disclosure. So here also 500,000. Then we have current asset. We have current asset. So we have say inventory or stock. This is 250, and here is 250. Then we have debtors. Debtors it's 100,000. 100,000. We have bill receivable. We have bill receivable. We have bill receivable. Of course, here, we have bill receivable. Here it's nil, but here it's 50. Then we have bank account. Now, bank here we have 150, and here it's 100. So the total current asset, this is 350, 500. And here also the amount will be the same, 500. Now the total asset of course will be 1 million for A and B. Total asset will be 1 million. But here the fact is that company A discounted bill receivable, and that is why the bank balance is 150, while B is waiting for maturity. The bill receivable here is 50,000. Now, in order to be transparent, you are supposed now, company A, to write a footnote here that there is a contingent liability of 50,000 for bill receivable. Now, without writing a contingent liability, we are not a full disclosure. We are supposed to be transparent. We are supposed to show everything, to say everything, so that users of accounting information can understand the financial statement. Then we have consistency. Once an accounting method has been chosen, that method should be used consistently, unless there is a sound reason to do otherwise. For example, method of calculating depreciation, charges, or valuing stock. Of course, this one we've already discussed, but as a conversion, we are supposed now to use the same method which we've selected. For example, if it's a straight line method, we are supposed to use it throughout. If the change is necessary, then the effect of that change should be shown in a financial statement and should be quantified and disclosed. Materiality. Only significant items should be considered when preparing financial statement. The purchase of small items like typewriters can be treated as an expense in large firms, but in small firms, treat as an asset. Material depends to the nature and the size of the firm. If your company is large, of course, we will take a asset like this typewriter as expenses. But to small, this one, it's a asset. So that one is a materiality. And the last is a substance of a form. Substance of a form is an accounting convention which states that transaction and the other events should be presented in accordance to their substance and the economic reality rather than their mere legal form, in order to present a true and a fair view of the affairs of the entity. A good example in a hire purchase account, we have a vendor and a vendor. But the possessor is the one who using that asset. Now, which statement of financial position you can select to write that asset? For owner or for possessor? Now, according to the subsistence of a form, we are supposed now to record that one in order to get the true picture of financial statement in the books of possessor. And this is our accounting convention. We are through with that, and next time when we meet, we will proceed with the other subtopic. If you have any question, you can ask. Otherwise, hoping that you have enjoyed the lesson, and I'm saying goodbye for today. Thank you very much.